Hey everybody, this is Lauren Stein, the Implementation Manager here at Alterity, and today we are going to be going over the warehousing options in Activate. So to get started, there are multiple ways to track your inventory in Activate via warehouses. The most common is, of course, the physical location you store your items in. This is the literal building you have on your property or off-site. If you have shelving set up in your warehouse or bins, we also have a module called Bin Locations to track those individual spots in each warehouse record. This allows the warehouse employees to quickly and efficiently pick or pack the items listed on the order without having to search the entire warehouse for those items. We also have virtual warehouses, which are also commonly used for things like receiving bay, quality control, returns, etc. For receiving bay, you would have the ship to location on the purchase order go to this receiving warehouse and then transfer to the main or quality control area after processing the receipt. These would be like locations within your physical warehouse if you weren't going to be doing something like bin locations. Some of our customers also utilize consignment warehousing, whether that's vendor or customer consignment. Vendor consignment actually forces you to change the setup of the warehouse accounts to ensure the only cost recognized for the transactions is the liability to your vendor and the profit from that vendor cost and the price you sell the items to your customer. This is due to the need to actually receive the items into stock but not have the value of the inventory asset that comes with a typical warehouse setup. Customer consignment, on the other hand, is processed the same as a regular inventoried item, but you would need to create a separate customer consignment warehouse in order to track which items are in your stock versus which items your customer has. For our EDI customers, we also have an option of 3PL. This is when you use a third-party warehouse that handles all the inventory for you, yet you are still responsible for the total value of the inventory. Via our EDI manager, you are able to send the order detail to the third party in order for them to fulfill the order and send back the information for your invoicing. The accounting setup is the same as it would be for a physical or virtual warehouse, but it would need to be a separate 3PL warehouse record to keep things separate, since EDI Manager goes off of the actual warehouse ID when you're processing those transactions, and that's linked to the order detail. When configuring both physical and virtual warehouses, you'll need to specify the warehouse ID and description. For the physical warehouses, you'll also need the name, attention, address, and contact information. This will populate on the purchase order document sent to your vendor, as well as any work order or transfer documents. Users also have the ability to set a default ship via and FOB information for each warehouse record. The warehouses themselves will each have their own GL accounts assigned for both inventoried and non-inventoried items. For those customers utilizing bin locations, you'll need the location itself and the zone within your warehouse. The count sheets will sort based on zone, then location when using the location product ID sort option. Without the zones, the count sheet will sort based on product ID alone or the sequence if you're importing the locations. And we also have a bin location import, which gives you the option to specify that sequence in order to get the count sheets properly sorted. Setting up bin locations is in another screen and configuration manager than the one you see on screen right now, which we will definitely go over during the actual demo. Okay, so we have two sections for warehouse GL accounts. The first is the inventory general ledger accounts. These are used for every type of transaction you post for an inventoried or special order item. The inventory asset account will need to be an other current asset. Typically, customers will give it the literal name of an inventory asset. Other customers will elect to set up a parent-child relationship within their asset accounts in order to track each type of item. To assign those separate inventory asset accounts to an item, you would need to create multiple warehouse records and add them to the items accordingly. We also have what we call a purchases account. This account is used during the receipt process. We are constantly being asked in implementation and support why there is a need for this account. The reasoning behind this is due to the nature of double entry accounting. When you receive an item, we will use the inventory asset and purchases account. The purchases account will hold the value of the items that have been received but not invoiced until the point of invoicing your purchase order. At that time, when you actually invoice the purchase order, Activate will create a vendor bill in QuickBooks which reconciles this purchases account on the expenses tab of the vendor bill, which you'll see in QuickBooks itself. Even if you receive the item at a different cost than what's listed on the vendor invoice, Activate will actually update the original receipt journal sent to QuickBooks to ensure the reconciliation nets at 0 for that account. I can't stress the importance of keeping this account set to an other current liability. Preferably, it would stay as accrued purchase receipts to ensure the visibility in your general ledger is clear. Changing it to something like cost of goods sold would never make sense, as that is the account used during the actual sale of your item and shouldn't be included in the receipt of that item. The adjustments account will be utilized during an inventory adjustment or inventory count transaction. This account should be set to a cost of goods sold type account that's separate than what you would use in the product class. This is also to ensure the visibility necessary for cost accounting when managing your inventory. We also have what we call a gain-loss account. This account is used during an inventory balance adjustment transaction. In essence, this transaction is changing the value of your items. This means the general ledger account will need to either be a cost of goods sold or expense type account. A lot of our customers use the same account as the inventory adjustment account, but some prefer them to be separate. So in this example that you see on screen, I've got it set to a separate account named Gain Loss on Inventory. That's just to keep the visibility in the general ledger clear on what transactions were being posted for each of these types of transactions. We also have an inventory issue GL account. Typically customers will use a cost of goods sold or expense type account for this one as well. You can change this on the actual inventory issue window, or you can actually lock the ability for users to change this. A lot of our customers will use the inventory adjustment account or some other expense account for this specific transaction. And last but not least, on the inventory side, we have a landed cost account, which is utilized for just that, the landed cost module. This is used in the same way as accrued purchase receipts for the purchases account you choose to use. When you increase or decrease your inventory via a landed cost transaction, we will use the inventory asset and landed cost accounts. And just like the receipt and vendor bill, for a vendor bill side of the entry for landed cost, we use the accounts payable and reconcile to the landed cost account specified on that inventory warehouse. This is exactly like the process for your purchases account. And again, customers should leave this as accrued landed costs, which is an other current liability. When doing vendor consignment, the accounts will be set up a little bit differently. All the warehouse accounts should point to the same account. Typically that's going to be a consignment adjustment account, which is an expense type account. This is due to you not recognizing the actual inventory value of those items on your financial statements, but you do need to receive those items into a consignment warehouse so you know that you have these items actually on hand. When you receive, the net result in your books will be 0. The sale to that vendor are the only transactions that actually leave a value. You'll end up with a vendor bill for those items sold and the difference between the cost and the price to your customer as your income. And to give you a little bit more insight about vendor consignment, because we do get asked about this a lot as well, I've set up a chart right here to show you the flow of accounting to see how everything goes through your general ledger when using this consignment adjustment account. When you receive Activate, we'll actually debit and credit the same consignment adjustment GL account, which nets the transaction at 0. And this goes back to me telling you that you should have all of the accounts set to this consignment adjustment account. When you sell the item to your customer, the cost of goods sold portion of the entry will be to the consignment adjustment account again, and the cost of goods sold associated with the product class. The income portion of the entry is the same as regular entries hitting accounts receivable, and the income account associated with the product class. That portion I have not shown on screen, but it is exactly like it would be on a normal transaction. You would then invoice your vendor specifically for those items that were sold, which would reconcile the consignment adjustment account and increase accounts payable. The net result is a liability to your vendor, and the difference between the cost and the price of the item as income. The other section of general ledger accounts for your warehouse is for the non-inventoried items. The product item types are what drive these accounts. The non-inventoried cost offset account will only be used for non-inventoried items utilizing the standard cost method. The same goes for labor, other charges, and shipping items. Users will need to assign a standard cost to each warehouse for the items utilizing the standard cost method, as they could be different based on geographical regions. For example, the standard cost for labor in California is likely higher than Texas. So keep in mind that this will be based on the stocking unit per item. The standard cost itself will increase or debit the cost of goods sold account when non-inventoried item is on a sales invoice, including as a kit component. And the non-inventoried item using the standard cost method may be included as a component of an inventory assembly transaction as well. In this case, the standard cost amount will increase the inventory value of the assembled finished good item, and it will also be offset by whatever account you have set on this non-inventoried section of the warehouse. All accounting transactions, including standard costs for non-inventoried items, must have an offset account. This is commonly referred to as double entry accounting. The offset account for standard costs for non-inventoried items is defined for each warehouse, and it will accrue the total standard cost for each item type until a general journal entry is created to clear that account. It can be confusing to picture the flow of the offset account, so I've listed a couple of examples here on the screen. The first one is a sales invoice that includes labor as an item. The income portion of the invoice will hit accounts receivable from the branch and the income account specified on the product class. The cost portion of the invoice will hit the cost of goods sold account assigned to the product class and the labor cost offset account assigned to the warehouse. If you are using labor on an assembly, the standard cost will be included in the cost roll-up of the components using the labor cost offset account as the credit side of the entry to build the finished good into the inventory asset account. If you aren't using labor in an inventory transaction, you'll need to manually adjust the value out of the expense account into the proper one. You can see here the payroll expense and bank account being hit when you cut your payroll checks. Your accountant will need to move the value of the labor cost offset account to the payroll expense to reconcile the balance. The standard cost offset account is cleared by the actual expense, such as payroll or a vendor bill. The actual expense may not match the standard cost. This discrepancy usually remains in the original expense account, like payroll expense, but may be adjusted through the general journal entry as well. So please talk with your accountant to decide how to account for these standard cost variances. Alright, so let's take a look at how all this works in Activate. First, we're going to take a look at the configuration of the chart of accounts in QuickBooks. So as you can see, accrued purchase receipts as well as accrued landed costs are both other current liabilities. I've also set up a consignment adjustment account as an expense account and a gain loss on inventory account as also an expense account. And then we also have the inventory adjustment set up as a cost of goods sold, and then we also have inventory asset as other current assets. And as you can see, I've separated the inventory asset accounts out into parent-child relationships in QuickBooks for clarity on financial reporting for your inventory asset value. I went ahead and received items into each one for demo purposes so you can actually see a value in each. And also I'd like to show you that if you run the standard balance sheet, you'll be able to see the breakout as well. So as you can see, we've got the 3PL inventory, Dallas, Fort Worth, receiving bay, and then we also have some uncategorized inventory asset values here. So let's take a look at how we set these up in Activate on your actual warehouses. So to do that, we go to File, Configuration Management, Inventory, and then Warehouse. So as you can see here, I went ahead and assigned those broken out, the parent-child relationship asset accounts to each of these warehouses. We've got a Dallas warehouse, a Dallas special orders, Fort Worth special order, receiving bay for Dallas specifically. We've also got a third-party logistics and vendor consignment. So if you like, you could also split out the purchases, adjustment, gain, loss, issue, and even the landed cost accounts for each warehouse. But the most common practice is to use a standard account for all warehouses, but we do have customers who like to see breakouts on not only Activate, but also on their balance sheets whenever they're running their financial reports. I've also assigned non-inventoried accounts to the Dallas, Fort Worth, and receiving warehouses. All of these general ledger accounts are expense accounts. These are based on the demo company setup we send to every customer. Feel free to use other expense accounts for the non-inventoried offset accounts. Let's take a look at this vendor consignment. Let's go to the inventoried accounts. As you can see, all of the accounts are the consignment adjustment account. This is due to the nature of vendor consignment. You'll need to actually receive the items into consignment stock, but having the inventory and the purchases account point to the same account actually makes the transaction net at zero, but still gives you the ability to see that you do have some quantity on hand for those the vendor consignment. The value is actually recognized as a liability to your vendor when you sell the item to a customer, as well as the income received from said sale. And as I said before, we also have bin locations. You can enable the bin locations in this locations portion of Configuration Manager. So you just hit Edit and Enable. Now you can see here that we have convert existing locations, warehouse locations, lot serial locations, select delimiters for multiple locations, and then generate a preview. This actually pulls from the generic locations that you set up on your product window when you're not using the bin location module. So when you have those locations, which I actually don't because I had already enabled bin locations and set them up. When you click preview, it will give you a preview for every warehouse on what the locations would look like. And then once you're ready, you hit create, and then it'll actually create those warehouse bin locations. As you can see, there are multiple bin locations already in the list with zones specified. This is how Activate will sort your inventory counts when sorted by location and then product ID. You can mark specific locations as being active or inactive by checking or unchecking this active box. If you didn't have any configured, we do have a location import, which I'll be showing you here in a minute. And in that import, you can specify a location as well as a zone and a sequence. And then here I'll toggle between here so you can see that both the Dallas and Fort Worth warehouse have bin locations. We don't have any for vendor consignment or the receiving bay for Dallas because obviously it's just going to be one location itself. You can also resort the list. So let's say you're going through and you're adding locations and it gets out of order. You just click resort list and it will actually resort the list based on the location, and it'll be alphabetically. So let's take a look at what the import looks like if you're creating these bin locations from scratch. And to get to that screen, you go File, Import Data, and then Warehouse Locations. And a side note to this is this Warehouse Locations import is only going to be available once you've actually enabled bin locations. If you've got the module and you haven't actually clicked that Enable button in Configuration Manager, you won't see this Warehouse Locations import. So make sure that when you're creating bin locations via an import that you go ahead and enable that module in Configuration Manager before you do this. So like I said, you just click on Warehouse Locations and create mapping. You'll go ahead and select a spreadsheet by clicking this Browse button on the file name. And if you have multiple tabs on that spreadsheet, you would select that on the worksheet. You would give the mapping an ID, a name, and a description. And then on the actual columns, this is where you would map Let's say if you wanted to import inactive bins or make some bins inactive, you could map this active field to a column in your spreadsheet. Here's the bin location itself. And then if you're changing the location name, it would be new location. And then also here's the sequence. So if you're not going to set up zones, you would need to make sure to import a sequence. So whenever you're printing your count sheets, it will actually sort based on that sequence. The specific warehouse you're setting up that bin location for, and then again, here's the zone. Okay, so let's take a look at what all these warehouses look like on a product. So I've set up B10 with everything except for the consignment warehouse and the special order warehouses, because let's say we don't ever really special order it, we actually stock this item in our physical warehouses. So we've got on hand and available quantities in D, F, the receiving bay in Dallas, as well as our third-party logistics company. So what this does is, let's go ahead and create a purchase order. So on the purchase order screen, let's go ahead and create a new one. Okay, so on the purchase order screen, you would actually need to specify the warehouse that you're wanting to receive those items into the ship to address. So let's go ahead and receive, let's say we're ordering for our Dallas warehouse, and Dallas requires us to receive into the actual receiving bay. So we change that ship to address to go to the receiving bay in Dallas. Then we go to the detail and we add, let's say B10 again. We have a pop-up note on that product window. And let's order 20. All right, and then we'll need to change this to issued because we've actually issued this purchase order to Adams Paper. Hit save, and then we click receive from the purchase order itself. And as you can see, it actually defaults to this receiving bay in Dallas, and you actually won't be able to change this on the receipt window since it's related to that purchase order. So if you did need to receive it into a different warehouse, you would actually need to undo this receipt, go back to the purchase order, edit it, and change the ship to location for the actual purchase order itself. And then click receive again and bring up this window. So let's go ahead and receive this into our receiving bay. And it'll give us an inventory receipts report, which tells us that we received it into this receiving bay, what PO it's related to, as well as the vendor. You're more than welcome to print this out, but this report will always be available to you in the reports menu for the inventory management transactions. And that goes for all the inventory transactions. All right, and now the receiving bay in Dallas will have 40 on hand as well as available, because typically we're not going to sell out of a receiving bay. We'll want to transfer that item actually into the main warehouse. So let's go ahead and take a look at how that's done. So we go to, let's say our warehouse workers have processed the receipt, it's in the receiving bay, and they're ready to move that pallet over into the main part of the warehouse. So we go to inventory transfers, we hit new, make sure to specify the warehouse before you add any items to the transaction. You can add any reference information, transfer document information, or description if you need to, and then you go ahead and add the item B10. We're going to transfer 10 of those items out because 10 of those still need to be checked by our warehouse workers. And since we have the bin location module enabled, you can see this from location and to location. We don't have any locations specified for the receiving bay because obviously that's just going to be one section of your warehouse, but we do have locations specified for the Dallas warehouse, and this is actually the only warehouse right now that's the primary warehouse that has quantity on hand. You can override this location to add locations to your warehouse. Say if you wanted it to be K31 instead of K30, you would just override it here. So let's go ahead and save. And before we post this transaction, if you are actually transferring items from one physical location to a different physical location, let's say you're transferring from Dallas to Fort Worth, you can actually print this document and it'll give you the inventory transfer form that you can put on your truck to say, you know, it's coming from this Dallas warehouse, which this address right here is from the receiving, and then it's going to our Greenville location, also in Dallas. But if it was from Fort Worth to Dallas, it would be from Fort Worth to Dallas, and so forth. And then you could also have the warehouse people mark what's actually been shipped on that truck to transfer to the new warehouse. Okay, and then when you actually post the transaction, a different report will post, and this is the actual inventory transfer register. This shows you the detail. So it says that 10 went out of one warehouse and 10 went into another warehouse, and the transaction should always be 0. And then you can also see the from and to warehouse as well in the header of the information. Also take note, you can see which inventory account is being used, and again, this is based on the setup in Configuration Manager. So now we go back to the product and we refresh it, and now they have 432 on hand and receiving is down to 30. And let's go ahead and synchronize these transactions to QuickBooks so you can see how that affected our general ledger. So you can go back to either the balance sheet again. You can take a look at your total inventory value in your receiving bay or in your Dallas inventory. Or you could actually drill down into the inventory asset accounts and look at the Dallas inventory, and you can see that that transfer came from the receiving bay and into this Dallas inventory account. And yes, the transfer will go between the two asset accounts, and since I have those split out, that's why you saw a different one for each of these. So now we have this general journal Dallas inventory. And then also, since we haven't created the vendor bill yet, you'll see a balance in accrued purchase receipts for the receiving bay itself. Now this will be reconciled once you actually create that vendor invoice. So let's go ahead and do that. You'll need to specify the invoice number, so we'll just put in a dummy invoice number and the invoice date as well. And you can see the due date will be set based on the terms from the purchase order itself. If there's a discount, you'll see a discount date as well as a discount amount. On the detail, Activate will automatically approve anything that you've received. So since we've received the full 20, it will automatically approve it. If you're doing a purchase order that included non-inventoried items, you would actually need to manually approve those items on the PO invoice. And to do that, you literally just type in the approved amount and override it from 0 to whatever you actually received. Alright, and then once you're ready, the purchase invoice matches the invoice that you have in your hand. Then you hit save and create invoice. And it'll ask you if you want to mark your purchase order as complete if you're actually invoicing everything that was listed on that purchase order. So we'll hit yes. Now before we go in and run a synchronization, I just want to point out that the balance of this is $80 for accrued purchase receipts. Now let's go ahead and synchronize that invoice to QuickBooks. And take a look at that balance again. And as you can see, it is decreased by $40, which is what we just invoiced to our vendor Adams Paper. Okay, so let's take a look at that vendor invoice so you can actually see how the reconciliation happens. So whenever you're using Activate, the vendor invoices, instead of being on the Items tab of the vendor bill, will show on the Expenses tab of the vendor bill. And as you can see here, this is where we reconcile accrued purchase receipts. So that's why we can't stress enough that if you're not going to be creating purchase invoices in Activate, which we do not recommend, but we do have some customers that, let's say, will pay with a credit card, so they don't actually create a PO invoice itself. Whenever you're paying that vendor bill with your credit card, make sure you hit your purchases account, which typically, again, is going to be accrued purchase receipts. I have had in the past helped out with a customer in support where they were putting everything to inventory asset, which obviously that's not going to reconcile accrued purchase receipts, and their accrued purchase receipts balance was just out of this world. So they actually had to go back to those payments that they had and change the expenses to accrued purchase receipts. But again, you're not going to have to worry about that if you are creating the vendor invoice in Activate, doing the whole flow within Activate without doing anything separately in QuickBooks. All right. So let's create a new order for B10 so we can see how the accounting flows for orders and how warehouses come into play for orders. All right, the bill to and ship to address are going to come from the actual customer record on a sales order. So it's not going to be like purchase orders where you would change the ship to address to a specific warehouse. This on the detail is where you would actually specify the warehouse. So as you can see, the default for the Dallas branch, which the branch is over here in the header, is actually the Dallas warehouse. So you can actually change the warehouse you're going to be shipping out of. So let's say you're shipping out of maybe your 3PL. You would actually need to change the warehouse to 3PL because that's how EDI Manager knows which order detail lines to send to your third-party logistics provider. And also take note, you can see all the warehouse on hand, available, scheduled, back ordered, required, reserved, and on order quantities. So maybe if the default is D, and let's say D doesn't have enough available quantities, but you look at your warehouse and F does have enough available, you can actually toggle that on the order itself. So we'll change it back to D, and then we'll leave it as the default. So, and then you can see here also, since we have that location enabled, you'll have the ability to toggle the locations here. So we have the K30 primary location that has stock on hand, and if we change it to, let's say, the F warehouse, it looks like W18 is the actual warehouse that has inventory on hand. And then obviously if you go to receiving, there's not going to be a warehouse because there is no actual bin locations for that receiving warehouse. So let's leave it at D. And then, as I said during the actual presentation portion of this, the inventory accounts used during transactions are specified on each warehouse. So this invoice will hit the inventory asset account assigned to the Dallas warehouse. So let's go ahead and hit save, and we'll create this invoice. And they paid us cash. They're at our counter right now, and then so we're going to release that invoice. And so let's synchronize that over to QuickBooks. And before we do that, let's take a look at the Dallas inventory asset value. $158,950.75. Close that, take a look, and now it's gone down slightly. There wasn't a whole lot of cost associated with that actual item. It's this cost of goods sold, $1.97 for that actual invoice in Activate. And then if we take a look at that customer invoice in QuickBooks, it's actually showed as paid because we released the invoice with a payment. And then if you like, we can take a look at the actual transaction journal. So it hit accounts receivable, the sales account associated with that product class, and then we also had some sales tax payable. And that's the income or receivable side of those journals. Because earlier we saw the cost side in the actual inventory asset account. Okay, so let's take a look at non-inventoried items such as labor. I've gone ahead and set up a standard cost for labor. As you can see, the cost method is standard. Again, the offset accounts for those non-inventoried items in your warehouse will only be used if you set this cost method to standard. So the Dallas standard cost is 10 and the Fort Worth standard cost is 9. And this is actually used in an assembly for this red knit shirt large. So we're going to go ahead and create an inventory assembly transaction so you can see what happens with the offset accounts and how it affects the value of said assembly. So we'll hit new. We'll go ahead and add the product. You can either manually type it or select it from the lookup window. If you manually type it, when you tab, it'll actually select that product and pull in all the items from your component list. And as you can see, when I change the quantity to 5 from 1, the total quantity actually does change. I'll change that back to 5. If you want to build it into a location, you would specify that in the location field. You can also use workflow statuses, entered, scheduled, in process, completed, or canceled if you're going to be using this at the manufacturing side of it. And then the warehouses for your components actually come into play in the detail of the components of the assembly work order itself. So we're building it in Warehouse D, and let's say we're going to use our components out of Warehouse D as well. Well, let's say maybe we're building it into a different location, so we're going to be using maybe the Fort Worth warehouse. You can actually toggle that on this warehouse field itself. So let's say if maybe D doesn't have enough T18 on hand, you can actually change it to come out of warehouse F. And then you would also need to notify your warehouse employees that, hey, we need to pull this from F, so we possibly need to do another transfer as well to get that inventory into F. And that goes for all of the components. You'll be able to see all the on-hand and availability for those components, as well as any locations. None of these have a location specified, so that's why you see this blank location. If you're going to be using locations, we definitely recommend actually specifying that for each of the items, but not all of our customers will do that, so we've kept them blank here. So let's go ahead and hit save. And if we print before we actually post this assembly work order, it's just going to give you the information. You know, we're going to be pulling from Warehouse D, and it'll give you any location information. It'll also give you the actual quantity that you're supposed to be using. So this will be what you actually hand your warehouse employees to build this item. So when you actually post it, it'll give you the unit cost for not only the components, but also the finished good. The reason we don't print the unit cost before you actually post the transaction is because unit costs can fluctuate, especially if you're doing average cost or maybe a layered costing. That cost can actually change if you're doing average cost based on if you've received more items in from the time you actually created the inventory assembly transaction between the time that you're actually posting it. The average cost can change a little bit. Let's say if your vendor increased or decreased their cost, the average cost will change slightly. So we can't really give you a prediction on what the finished good will cost until you've actually posted the transaction. And that goes the same for FIFO, because FIFO is date-based. So let's say if you've created this session as of 10/10, and as of that date, you would be using a different FIFO layer than, let's say, if you change that session date of the inventory assembly to be today, it would actually use a different FIFO layer based on the sales transactions if that layer is still available or not. So let's take a look at this non-inventoried item labor. So we've got this labor charges, and the reason we have a cost for labor is because we set that standard cost on the item itself. So we use 2.5 hours of labor. The unit cost for that is $10, and that's from the Dallas warehouse. So the total amount of labor is $25. And as you can see, it does it for the rest of the inventoried items, but we wanted to focus on the non-inventoried item for this transaction. And then it also rolls up the entire cost of the components into a unit cost of $10.77, as well as a total amount of $53.85. And you're also going to want to see a transaction total of $0 because obviously, you know, the finished good cost is going to be a sum of all the components. Let's go ahead and close this report. The assembly has been posted. Let's synchronize that with QuickBooks. And we'll see an increase in the Dallas warehouse inventory asset account, as well as the expense account that we actually used for the labor item, which is the printing and reproduction. So now you see this, we've got $25 right here is what we use for that assembly session. And that is what you would need to reconcile, or your accountant would need to reconcile, you know, let's say when they're paying payroll, they would pull that expense and put that into the payroll expense when they're actually cutting the checks for your employees. We've got a question right here from Adam. How do you establish a realistic cost of labor? Do you take your average cost of all warehouse laborers with insurance, etc., as a default cost of labor? Actually, what our customers will do is they'll actually set up different labor items. So they'll have, let's say, like supervisor labor. Obviously, that's going to have a higher standard cost than, let's say, a regular just laborer in your warehouse, somebody that's going to be on the assembly line. That's going to have a different labor item. You could do what we call custom or process assemblies, and you could switch out the labor item that you're actually going to be using, so that way you have a true cost used during your assembly transaction. And yes, the standard cost would include, you know, the full cost of that labor, whether that includes the insurance or, you know, typically it's going to be like the actual hourly rate that you're charging for that labor, so you can reconcile that. If you did want to include all the insurance and you know, any other costs included in that labor, then obviously your accountant would need to know to move that expense out of whatever expense account you're using for the offset account into the proper like utility or insurance account whenever they're going to be paying those utilities. We did have a good question about the sales order detail. On the sales order detail, you saw that we have a scheduled quantity. When your sales order itself, the sales order status is set to scheduled, it will actually change the availability for your items. So let's go back to B10 and we'll take a look at this availability in this D warehouse. So if we create a new sales order for somebody that's going to be buying out of the Dallas warehouse and we add B10, let's say 10 of them just for ease of use. If we save this sales order, and notice the status is scheduled, if we save this sales order, the actual availability for this item will go down by 10, and you'll actually see this scheduled of 10 on this inventory tab. Now, if you're using a status of booked, that actually won't change your availability at all. Some customers will use this for, let's say, future orders. So if I change that status to booked and I go back and refresh, it actually doesn't affect the availability at all. So the availability is going to be affected when you actually have a status of scheduled and you've actually scheduled these lines. And that's in this scheduled box right here. Some people said they don't define their labor costs and they leave it at 0. If you're processing assemblies and you're wanting that assembly to actually include the cost of labor that you're employees are actually doing the work on the assembly, then yes, you would need to specify a standard cost, whether that is the actual hourly rate for that specific employee. And if you are doing it based on the specific employee, then you would need to create multiple labor items to accommodate for each of those different standard costs. If you have multiple 3PL warehouse locations, yes, you would set up a warehouse location for each different 3PL provider. Now that's because whenever you're running those EDI transactions, Activate EDI Manager is actually grabbing the warehouse ID from the order detail. I only set up one 3PL warehouse just for demonstration purposes, but we do actually have customers that have multiple 3PL providers. And in that instance, yes, you would need to set up a separate 3PL warehouse for each of the 3PL provider locations. And releasing an order to 3PL, that's actually done via EDI Manager, which I don't have set up for this demo. If you do need any assistance with that, we would be more than happy to go through that with you. We're not doing that in this demo just because that's very specific to our EDI module. And if you populate a labor cost, can you mask that field from employees? You can block viewing cost for specific employees, but that actually blocks every cost, not just specifically labor cost. And that's going to be in the user configuration. Okay, a supplier return. Let's go ahead and process that real quick. So let's say something happened to some of the items, or we just don't need some of these items in our warehouse and we want to actually return these to Adams Paper, which is the one we used earlier. So you would set up just a regular purchase order, add B10, or whichever item you were going to be returning, and instead of having a positive number, you would actually do, let's say we received in 10, but we're going to return 5. So we would actually change the ordered quantity to -5, which as you can see makes the amount -10. And then, we'll send that to our vendor if we need to, and then we'll actually click receive. And whenever you receive that item, it's still going to have this negative. So what this is if you have a negative, it's actually going to take that out of your inventory, just as you would be doing when you're actually returning the items. So we'll hit save, we'll keep the date as today, and hit post. And as you can see on the left hand side, the on-hand quantity is 440 for F right now. And then hit yes. Don't have to print that. We close out the receipt. We've received it as a -5. So if we refresh this item, now we have 435. And then let's say your vendor has a restocking fee that's going to be applied to this invoice, which it's technically a credit from your vendor. So you would go, add the invoice number, the invoice date, and the other amount is where you would actually do the restocking fee. Let's say it's, 10%, so we've got $1, and then you would select the expense account. You would have probably a specific expense account. We're just going to do uncategorized for now. Hit save. All right, and then you create the invoice. And that is a vendor return. All right, it looks like we've got most of the questions answered. As always, check out our help site for further information on warehousing or for any other questions you may have. You can choose from the drop-downs on the header of the page or search for specific keywords. Thank you for your time, everybody, today. I hope you enjoyed the presentation on warehousing options, and I hope you enjoy the rest of your day.